Okay, let's dive right into this. If you are a financial analyst trying to figure out exactly where global capital is flowing right now, well, you're in the right place. Today's explainer is a fast paced briefing on the macro thematic sector shifts that are actively defining our current market environment. We are seeing incredibly aggressive corporate restructuring, massive capital raises, and shifting regulatory landscapes. And it's all happening at once.
So here's our roadmap. We're going to synthesize these disparate corporate moves to see where the money is really going. We'll hit the AI and tech pivot, heavy industry capital allocation, consumer pressures and regulations, and strategic financial maneuvering. Finally, we'll wrap it all up with the macro analyst takeaway.
Section 1, the AI and tech pivot. AI exuberance isn't just a narrative anymore. It is literally forcing rapid corporate restructuring and completely redefining what the market expects. Take Samsung. They just reported a Q2 operating profit of 89.4 trillion won. For those of us tracking in US dollars, that's roughly 58 billion. 58 billion! That is a nearly 20-fold increase from just a year ago, driven almost entirely by this insane demand for AI memory chips.
But as an analyst, absolute numbers are only half the story. The real head-scratcher here is this. On the back of a 20-fold profit increase, why did Samsung shares actually drop by 7%? Well, it's the classic priced-in paradox. Market expectations for AI infrastructure have gotten so incredibly high that even a $58 billion profit just flat-out missed the mark. Basically, absolute perfection is already priced into the semiconductor space right now.
And because the stakes are so astronomically high, companies are violently shifting resources to capture this momentum. Look at Microsoft. They're cutting 4,800 jobs, and get this, 3,200 of those are hitting their Xbox gaming division. That's not just your standard corporate trimming. That is a massive, deliberate pivot away from legacy entertainment sectors and directly into AI and high-growth enterprise businesses. We're also seeing wild momentum shifts in the hardware space driven by political catalysts. Recently, President Trump explicitly told Americans to, quote, buy a Dell computer. And as you'd probably expect, that straightforward endorsement immediately sent Dell shares trading higher as the market reacted. To give you the full context on that market move, this endorsement happened during a White House event, launching a new initiative called the Trump Accounts Program. At the launch, Michael and Susan Dell actually pledged over $6 billion to the program. The market quickly digested both that massive pledge and the resulting endorsement, pushing the hardware giant's equity value right up. But big tech isn't just looking at immediate hardware and AI needs. They're looking way down the road at massive energy demands. Google just backed a 411 million euro, or about $468 million funding round for Proxima Fusion. It's a German startup with an incredibly ambitious goal, building Europe's first commercial fusion power plant later this decade. Bottom line, tech giants know they absolutely need next-gen baseload power to sustain this AI boom. Section 2. Heavy industry capital allocation. Now, what's really interesting about this slide is the stark contrast in capital strategy when we move away from digital and over to physical heavy industry. You've got Rivian, the EV challenger, relying on a 75 million share public offering to raise about 1.5 billion in vital operational cash. Contrast that with legacy titan Toyota, who's deploying $3.6 billion of its own capital directly into a Texas manufacturing plant to build Tacomas, adding real jobs and hard capacity by 2030. It's a classic case of equity dilution versus massive internal reinvestment. But Rivian's situation definitely requires a bit of nuance. Sure, their stock dropped about 10% when the share offering was announced, which is just the mathematical reality of dilution. But actually, their Q2 revenue forecast of 1.55 to 1.65 billion solidly beat Wall Street estimates. So the underlying business is generating more revenue than expected, even as they grab external lifelines to scale. Meanwhile, in the energy sector, volatility is basically printing money for the right players. Shell just raised its Q2 gas production guidance, and more importantly, they are expecting significantly stronger gas trading results. They aren't just extracting resources, their trading desks are actively capitalizing on chaotic global energy swings to generate outsized returns. Section 3, consumer pressures and regulations. So while tech and heavy industry are throwing billions around, giant corporations on the ground are facing some brutal macro headwinds. Look at this split screen. On one side, Walmart is aggressively slashing prices. We're talking 12% off ground beef, a third off a 24-pack of Coke. Why? Because the consumer is totally exhausted by persistent food inflation, and Walmart is willing to squeeze its own margins to defend market share and boost affordability. On the other side, Meta is staring down an existential regulatory threat.
4 U.S. states are seeking up to $1.4 trillion, yes, trillion with a T, dollars in potential penalties ahead of an August youth safety trial. So you've got ground-level consumer exhaustion on the left and massive sovereign regulatory tail risk on the right.
Section 4, Strategic Financial Maneuvering.
Now let's jump into the financial sector, where both nimble fintechs and legacy banks are aggressively maneuvering to protect their margins. Look at this lineup: JPMorgan Chase, Bank of America, Wells Fargo, and PNC Financial. These fierce traditional rivals have actually been in preliminary talks to jointly acquire a Pfizer debit card network. When the biggest banks in the country team up for an acquisition, as an analyst, you really have to ask yourself, what exactly is the underlying strategy here?
Well, the strategy is incredibly calculated. They want to completely bypass debit fee caps. By owning the actual network infrastructure, they're trying to vertically integrate and protect their fee revenue from tightening regulations. Naturally, a mega consortium trying to sidestep fee caps is going to face a mountain of antitrust scrutiny, but the fact they're even exploring it shows just how aggressively they want to protect those margins.
And on the flip side, you have fintech darling Klarna doing basically the exact opposite. They are actively trying to become a traditional bank. They've actually applied for a U.S. bank charter to set up an FDIC-insured subsidiary. The goal? Fund their loans using cheap customer deposits instead of expensive external capital. It's a fundamental shift away from partner banks, giving them total control over their own balance sheet.
Section 5, the macro analyst takeaway.
So the crucial point is, how do we tie all this together? We've got massive AI capex, consumer inflation realities, and structural shifts in finance. Basically, the market is completely torn between high-tech exuberance and ground-level economics. AI is acting like a capital black hole, demanding huge investments today for payoffs tomorrow. Meanwhile, the consumer is stretched so thin that titans like Walmart have to fight inflation just to keep volume up. And as these mega caps balloon to historic valuations, regulatory scrutiny is scaling right alongside them. Which leaves us with one final, provocative question for you to model out. As we push forward into this highly volatile environment, will this massive wave of AI and manufacturing capex generate enough economic velocity to outpace the ongoing drag of consumer affordability? That is the trillion-dollar question. Thanks for joining me for this explainer, and I look forward to diving into the next set of market shifts with you soon.